What is going on, guys, and welcome back to the channel. I hope you're doing good and having an amazing day. Now, over the last couple of years, we've seen a huge spike of new retail investors starting to invest in the stock market, which is really great to see, but still that only accounts for 1/3 of the UK population who actively invest. So in today's video, I'm going to be going over 5 reasons as to why I think everyone should be investing in the stock market. I've been investing for almost a decade now, and clearly I'm a huge advocate for it. From seeing my own progress and others around me succeed, I just feel it's something that everyone could be taking advantage of. So hopefully the reasons I cover in this video might empower you to start investing for yourself if you're maybe on the fence, or at least learn something new. Now, just before we get into it, please do me a massive favour and smash that like button down below. As I'm sure you guys know, it just helps me out with the YouTube algorithm. And if you are new around here, make sure to hit that subscribe button down below and click that bell so you never miss a video. I've got loads more videos to come centred around investing and personal finance. As always though, just as a quick disclaimer, this is in no way financial advice. I'm simply just outlining information and giving my honest opinions and thoughts. Always make sure to do your own research and due diligence when it comes to your finances. But with all of that out of the way, let's get into the video. Okay, so the first point on the list, and honestly I think should be one of the biggest concerns for any non-investors, is the fact that your hard-earned savings are most likely losing value due to inflation. Now, if you don't know, inflation is effectively the term used for measuring the rise of prices of consumer goods and services in the economy. And so every year, no matter what country you live in, there will be an annual inflation rate, which will vary from year to year. And so last year, in 2020, within the UK, the annual inflation rate was around 0.85%. So effectively, the following year in 2021, all goods and services are 0.85% more expensive. So for example, a generic consumer product in 2020 valued at £100 would now cost you £100.85 in 2021. Now, partly due to the economic impact of the pandemic, we're starting to see inflation rates skyrocket. So in August of this year, the rate was 3.2%, in September 3%, and October 4.1%. Now, these rises in inflation don't always need to be a huge concern, but with that being said, increases in inflation can have a huge negative effect on your savings. And this is because most likely your savings are sat in a bank account earning interest on that money. But unfortunately, in most situations, that interest rate that you're being offered won't be as high as the actual inflation rate at the time. So effectively, the interest rate that you're being offered needs to be keeping up with the inflation rate to just be worth the same over time. So when looking at the best bank accounts out there at the moment, the top savings account only earns you 1.87%. And this account isn't actually instantly accessible, and your money will have to be locked away for 3 years. The top instant access account is just 0.75%. And considering the projected inflation rate for 2021 is 3.3%, you're really going to be losing quite a lot of value if you stick with a savings account. Now, as you might expect, the way to solve this problem, in my opinion, is to invest in the stock market. So if we just look at index funds, there are a number of different opportunities that will significantly outperform the returns you'd get from a savings account. Now, my favourite example is the S&P 500. This index is made up of the 500 largest trading US companies, and on average, since its inception, it's generated between 8 to 10% a year in growth. These returns aren't guaranteed though, and this is just an average, so some years it might actually go down in value, or in other years we might see it significantly outperform the average. So for example, this last year it's up almost 30%, which is definitely going to be leaving you beating the inflation rate and making some profit on top. But the trick is, with investing in index funds like this, is to simply just treat it like a savings account that you can't access. So all you've got to do is just buy and hold, don't worry if it goes down in value momentarily, and simply just hold it for the long term. And then you can start taking advantage of that average 8 to 10% a year in growth. Now, if you're watching this and you're still not convinced by the idea of investing, well actually you might need to think again, because there's a really strong chance that you're already invested in the stock market and you just don't realise it. In a survey in 2020, just 1/3 of British people said that they actually own stocks and shares. However, surprisingly, 2/3 of people also said that they do plan on investing, even if they're not already. So you might be thinking, what's holding this 1/3 of people back who are planning on investing but actually haven't yet? Well, it could be for a number of different reasons, but most likely it's down to fear. This could be fear of losing money, fear of failing, or just fear of the unknown. But what I think is really interesting is, even though just 1/3 of people said that they own stocks and shares, it's actually a much higher proportion of the population, and people just don't realise it. Now again, your money could be invested in a number of different ways without you realising it, but the one I'm thinking of is a workplace pension. So of people in the UK classed as workers, aged over 22 and earning more than £10,000 a year, 88% of these people are enrolled into a workplace pension. And the reason for this is that back in 2012, the government actually passed a law making it so employers must auto-enroll employees into a workplace pension scheme. And if you're not interested, you have to physically opt out. Now, the reason that this is so important is that the money sat in your workplace pension is going to be invested, at least partially, in the stock market. So if the thing holding you back from investing is the fear of the unknown, this might give you some comfort in knowing that you're actually already invested if you have a workplace pension. Now, I think this is a really great reality that people are actually invested, but the unfortunate thing is most of these workplace pensions aren't actually generating the best returns. But this is where it can become really quite encouraging, because actually it's really easy to outperform these workplace pension schemes. So if we just look at Nest Pensions as a quick example, they're one of the more popular workplace pension providers. And the fund that you'd be auto-enrolled in if you have a workplace pension with Nest would be the 2040 Retirement Fund. Now, over the past 5 years, this has generated 50% in growth, which honestly isn't too bad, and that's about 10% per year. But if we compare this performance to the S&P 500, which we looked at earlier, over the same 5-year period, this has increased by 108%, which is over double. Now, in my opinion, the reason that this Nest pension and so many other pension plans out there have such significantly poorer performance is due to the fact that they're basically over-diversified in other investment opportunities that just don't generate that much in returns. And so in my view, if you find a good investment that offers consistent high returns, why diversify into other poorer performing things? But again, if you are worried about starting investing, let this build your confidence that it actually can be really easy to outperform these pension plans. And remember that the S&P 500 is just a benchmark, and there are so many other more profitable opportunities out there. Now, leading on from this last point, I feel there's still a really big misconception about investing. And that's the idea that it's really difficult, hard to do, and you need to be a complete expert to generate some profit. Well, hopefully the example I've just used of the S&P 500 shows that that simply isn't true. People certainly do love to try and overcomplicate investing with complex terminology and jargon, but it's actually a lot more simple than you might think, and you really don't need to be an expert or a genius to start making some profits. So you don't need to waste time trying to build the perfect portfolio that's really diverse, or trying to time the market perfectly every time you buy or sell some shares. You can simply just get away with buying a few good long-term index funds and holding them over a longer period of time, and you will really start to see some promising returns. Also, gone are the days where investing is just for the richest 1%. These days, you can literally invest from your phone with as little as £5. And there are so many innovative apps and investment platforms out there that make the whole process really much more straightforward than it used to be. So one option could be using a do-it-for-me investment platform where you can auto-generate a portfolio based on the level of risk you're prepared to take. Or you can take a more hands-on approach and pick stocks and funds for yourself. With that being said, that brings us on really nicely to today's video sponsor. So today, this video is brought to you guys by Wombat Invest. Wombat is one of the UK's fastest growing mobile investment platforms out there, and they have a huge focus on making investing fun, easy, and accessible to beginners. There's a good range of investments within the platform, and the list is constantly growing. But what really sets Wombat apart from the other investment platforms is that their app actually cuts out all of the complicated investment jargon through the use of their themed funds. So these funds are exactly the same as the ones you'd find on other investment platforms, but Wombat have renamed them to make them more accessible and understandable to beginner investors, to allow you to know exactly what you're investing in without being really clued up on investment terminology. So instead of seeing the S&P 500 index fund, you'll see the All-American Fund. Also, as a bonus for you guys, Wombat will be giving you a free £20, and all you need to do is sign up for an account using my referral link, which is that top link in the description, and set up an account and invest just £10, and then Wombat will deposit that additional £20 for you to invest as well. So you really can't go wrong. But with all that being said, let's get back into the video. Okay, so another thing that I think is truly amazing about stock market investing, and again, I feel a lot of people do overlook it, is the fact that it's such a liquid investment. So when you consider what other asset classes you could invest your money into, one of the most popular alternatives is property. But one huge downside of property investing is simply just how much of a commitment it is. It can take a lot of time if you plan on buying and selling properties. So firstly, you need to find a property in the first place, instruct a solicitor, have surveys carried out, and then you also have the consideration that a buyer might be stuck in a chain to another property, which could cause more problems. Now, these are all kind of things that are basically just inevitable when it comes to buying a property. But where the real problems can arise is if your financial situation changes. So let's say something happens and you need to liquidate some of your investments. Selling a property won't really be a very good option, as you'll have to sell the entire thing, and it could take a very long time for it all to go through and you get that cash released. In contrast, with stock market investing, providing you're buying and selling investments with a high volume, it's incredibly quick and easy to do, and it's almost always instantaneous. And so again, if the worst does happen and you need to free up some cash, it's very easy to do so with stock market investments. And you also don't have to sell your entire portfolio, you can just sell whatever it is you need to free up. Now, I think liquidity is so important because basically our financial situations are always changing and we have to adapt. And so it's really good to just have that flexibility and know that your money is not completely tied up. The final thing to talk about is simply just how investing in the stock market can create a really solid foundation for your financial stability. So being completely honest, no matter what anyone says, investing isn't about getting rich quick, and it's very unlikely that you'll be able to consistently make a lot of money fast. And if you are lucky enough to do this, it's often not sustainable. So the type of investing that I'm more of an advocate for is more of a long-term discipline that over time can massively improve your financial situation, taking advantage of long-term growth. And so it's the difference between making 1% from a savings account or a 10% annual return from your investments. It maybe doesn't sound like a lot, but as an example, if we save £1,000 every single month for 20 years, it's the difference between having at the end of those 20 years £266,000, which you'd get from the 1% interest rate, and £766,000, which you get from the 10% annual return. And the great thing is as well, this 10% return really is just a benchmark, and you can start taking more ownership over your investments and finding more profitable opportunities. And so if, say, we increased our annual return from 10% to 15%, which is very achievable if you start investing seriously, that would turn that final sum of money after 20 years into £1.5 million. And I feel it's these sort of long-term investing habits that can really open up the road for you to retire early, afford the things that you've always wanted to do, and generally just be less dependent on your day job. These skills that you'll be learning will also be with you for life, so you'll be able to constantly look out for profitable opportunities, and again, it will just give you that added flexibility of having another skill that you can fall back on. But there we have it, that basically covers everything for today, guys, and if you did make it this far, thank you so much for watching. If you did enjoy the video and haven't already, please do me a massive favour and smash that like button down below. As like I said, it just really helps me out with the YouTube algorithm. And if you are new around here and like this sort of content based around personal finance and investing, make sure to hit that subscribe button down below and click that bell so you never miss a video. Also, do let me know your thoughts down below in the comments. And if you have any feedback or questions for me, just make sure to drop them down there as well, because I'll make sure to respond to all of you. But with all of that being said, take it easy guys and keep saving.
Oh.